Welcome back to the deep dive. Today we are tackling the Q3 2025 earnings call for Harvard Bioscience, Inc. That's ticker HBIO.
Yeah, this one was a real head scratcher. It's a life science tools company, and their call, which was back on November 6th, gave us one of the most, let's say, confusing mixed prints we've seen this season.
Right. And the company's in the middle of this really aggressive turnaround, so our mission here is to, cut through the noise.
Exactly. We need to separate the real operational progress from the accounting stuff and figure out why a company showing some pretty solid fundamental strength still saw its stock drop right after the call.
Okay, so let's start right there with what you called the headline dissonance. Because we had a revenue beat, but at the same time, a pretty big earnings per share miss.
Yeah, and you really need to know which of those two things the market reacted to first.
And it was the miss.
It was the miss. Absolutely. The market went straight to the bottom line disappointment, the GAAP EPS number. The consensus, what analysts were expecting, was a small profit, about a penny per share.
And
Instead, they reported a loss of 3 cents, a negative 3 cents. So that's a 4-cent miss. And that was the anchor. It just sent the stock down immediately, about 7%.
So traders just saw the miss, hit sell. Simple as that.
Pretty much.
Yeah.
But if you pause for just a second and looked at the top line, the revenue, it was a completely different story.
Right. Revenue came in at $20.6 million.
Which was a solid beat. It cleared the street's own guidance range, which was somewhere between 20 and 20.4 million.
So how does that happen? How do you beat on revenue but then miss so badly on earnings?
Well, it's often about timing, maybe some non-cash charges. But in this case, the real story, the operational success, was it was buried under that GAAP EPS number. You had to look at the margins.
Okay, let's talk margins.
Gross margin was 58.4%. And this wasn't just good. I mean, this was fantastic. It completely blew past their own guidance of 56 to 58%.
So how significant is a number like 58.4% for a company like this?
Oh, it's profoundly significant. I mean, to put it in context, that was up 200 basis points just from Q2, sequentially.
Wow.
Yeah. And that tells you they're not just selling more stuff. They are selling better stuff, a better product mix, and running their whole manufacturing operation way more efficiently.
So they're moving toward those higher margin products like telemetry.
Exactly. They're advanced telemetry systems. That and just, disciplined execution, a leaner cost structure. It all points to a real operational reinvention, not just some cyclical bounce.
And if they're expanding margins that quickly, they must be getting really aggressive on cost control. Management talked about cutting operating expenses, right?
It did. They took $1.4 million out of their operating expenses year over year.
For a company this size, that is a huge number.
It's substantial. And it wasn't an accident. This was the result of 3 very specific actions that the CEO, John Duke, he just kept hammering on during the call.
Okay, so let's unpack those because there's a bit of jargon in there.
For sure. So first, they moved to one single U.S. ERP system.
Enterprise resource planning.
Right. It's basically the company's nerve center. It handles manufacturing, supply chain, all the financial data.
Yep.
By getting it all into one system, they cut out a ton of redundant costs, streamlined the whole back office.
Classic efficiency play. And the second action.
Leaning out the SG&A organization. So selling, general, and administrative expenses.
The overhead.
Exactly. Corporate overhead, sales force, marketing spend. They just got a lot smarter about where every dollar was going, making sure it was driving growth on their most important products.
And number 3 was reprioritizing NPI projects. What's NPI?
New product introduction. So think R&D. They realized they just had too many projects going at once that weren't really hitting their strategic goals or their margin targets.
So they cut the lower return projects?
Yep. Canceled them.
Yeah.
And they funneled that R&D money only toward the things with proven high margin potential, like their next-gen organoid tools. That saved a lot of money.
So they're not just cutting for the sake of cutting. They're re-engineering the whole thing. The proof has to be in the cash flow, though. And that was, I think, the real aha moment of the quarter.
It was the most important number on the page. They generated positive operating cash flow of $1.1 million.
And you have to compare that to the year before.
You do. In the same period last year, they were burning cash, negative $800,000. So that's a swing of almost $2 million.
And year to date?
Year to date, they've generated $6.8 million in operating cash. That is a fundamental shift. They're going from a company that needs upside money to one that's becoming self-funding.
Which changes the entire balance sheet story. But how sustainable is that? Was it a one-time thing?
Management was really clear on this. It was driven by those operational improvements, the margin expansion, the cost discipline. They're managing inventory better, collecting receivables faster. It suggests the quality of that cash flow is high. It's not just an accounting trick.
And that kind of cash generation tells you that customer demand has to be pretty solid.
It is. And they were bullish on demand, which is really important right now because a lot of their peers in the life sciences space are reporting slower spending.
So what did they report?
Mid-single-digit order growth in Q3, year over year. And here's the kicker. 4 straight months of year-on-year growth. That consistency, that momentum, it pushed their backlog to its highest level in almost 2 years.
A 2-year high backlog is a powerful forward indicator.
It's huge. It gives them visibility. It gives them confidence. It means that even if an order gets delayed for some reason, the demand is locked in. The revenue will just show up later.
Which brings us to their other priorities. Beyond just cutting costs, they have to actually grow.
Right. Accelerating adoption of their core growth platforms. This is CEO John Duke's second pillar.
And what are those key technologies driving the growth?
It's really 3 high-tech, high-margin tools. First is telemetry, their Soho platform. It lets researchers monitor physiological data remotely. They're getting into key accounts, which drives recurring revenue from consumables. That's the margin engine.
Okay, what's number 2?
The MeshMEA organoid platform, this is fascinating stuff. Organoids are basically these 3D cell cultures that mimic actual human organs.
So like a mini organ in a dish.
Pretty much. And it's a much more realistic way to test drugs than old 2D cultures. And there's a huge regulatory push to reduce animal testing and improve drug safety screening. They are tapping right into that shift.
That makes the timing on that platform incredible. And the third one,
They just launched a new one, the Incubate Multi-Well system. This is for high-throughput applications. Think large-scale automated drug screening.
so if a big pharma company needs to test thousands of compounds at once.
This is the kind of system they need.
Right.
And selling these specialized high-value tools is exactly how they get their gross margin up into that 58 to 60% range.
But you can have the best tech in the world, and if you can't get into labs, it doesn't matter.
Which brings us to that big distribution deal they expanded.
Yes, the Fisher Scientific U.S. distribution agreement. This is a game changer for them.
How so? Well, think about it. Fisher Scientific has this enormous sales force, hundreds of reps with reach into every academic, government, and biopharma lab in North America. This deal basically puts HBIO's best products, like MeshMEA and their pumps, into the hands of a distribution network they could never, ever afford to build themselves.
So it's all pointing toward growth. But there have to be some weak spots. The macro environment is never perfect.
And it's not. China is the notable headwind. Revenue there was down almost 20%.
19.6% year over year.
Yeah. And while management is, cautiously optimistic they're through the worst of it, a drop like that in a key market, it shows you the terrain is still pretty uneven.
Okay, let's pivot to the investor side of this, because everything we've just talked about, the cash flow, the margins, the backlog, it all seems to be overshadowed by 2 huge non-operational issues.
The overhangs, debt and listing status. These 2 things are completely defining the stock's valuation right now. It's trading like a distressed asset, even with the turnaround happening.
So the debt, how bad is it?
Net debt is sitting around $27.5 million. And the clock is ticking on their credit agreement. They have to refinance it or repay it. Management said on the call they expect to get that done in Q4.
And getting that refi done without too much dilution, that has to be the number one catalyst for the stock.
It's everything. The market is pricing in a really bad outcome there. If they solve that one issue, the whole conversation immediately shifts from survival to turnaround potential.
And then there's the other risk, the NASDAQ listing status.
Microcap curse.
Yeah.
They have until March 30th, 2026 to get their stock price back above $1 and stay there.
And if they can't?
The fallback is a reverse split, which they said is an option, but they'd much rather see the operational story, the cash flow, the margins, drive the price up there organically.
Which is reflected in their Q4 guidance. They seem pretty confident.
They are. They guided Q4 revenue to between $22.5 and $24.5 million, with gross margins expanding even further to between 58 and 60%.
So, continued improvement.
Cementing the turnaround thesis.
Yeah.
But they did include one crucial caveat.
The government shutdown risk.
Yes. They explicitly said that the risk of a prolonged U.S. government shutdown is baked into the low end of that revenue range.
And that's because so many of their customers are funded by the NIH.
Exactly. But the key clarification they made is that the money isn't lost, it just shifts the timing. The orders get pushed into Q1 or Q2 of next year. It's a timing risk, not a demand destruction risk.
So with all this good operational news, why the initial 7% drop, and then why the huge rebound afterward?
The drop was just a reflex. Purely the headline EPS miss and fear about the debt. But then the fundamental investors came in.
They did the work.
They did the work. And over the next 1 to 3 months, the stock shot up. Up around 20%, then 45 to 50%. That's the market finally starting to validate the operational story, realizing the company was being valued way below its intrinsic worth because of those two big fears.
Which brings us to our segment where we try to translate all this into an idea.
This is not financial advice segment.
Let's do it. Given how deep the discount is here, record margins, positive cash flow, but a stock price under $1, what's the outrageous but plausible trade?
The entire trade hinges on them solving the debt problem. The idea is that the market is pricing in failure. So if or when management successfully refinances that debt in Q4, that single event removes the biggest uncertainty.
So you're betting that fixing the debt automatically fixes the NASDAQ problem without needing a reverse split.
Exactly. The debt refinance is the catalyst. It forces investors to stop looking at the balance sheet and start looking at the reality of the operations, the 58+% gross margins, the millions in cash flow, the 2-year high backlog.
And what's the price movement you'd be looking for?
The trade is just structurally long the equity. You're betting the debt resolution triggers a rally big enough to push the stock well over that $1 NASDAQ threshold way before the March 2026 deadline.
And the upside target?
Well, the average analyst price target is somewhere in the $2–2.5 range. That suggests the pros believe this company is worth 2, maybe 2.5 times its current price if the balance sheet gets fixed. So the trade is designed to capture that re-rating.
It's a highly leveraged bet on management delivering on that final critical pillar.
That's it. The operational turnaround is already here. It's ready. It just needs the capital structure to get out of its own way so the market can finally give them credit for it.
And that perfectly sums up the conflict of the whole quarter, doesn't it? An EPS miss that completely overshadowed these huge sustainable wins in margins and cash flow and demand.
Right. This whole discussion about Harvard Bioscience really boils down to one question. Can a small life science roll-up pivot from just managing debt and complexity to actually funding its own high-margin growth?
The ultimate pivot from survival mode
to cautiously credible growth. The numbers say they've already made the pivot. The market is just waiting for that final piece of proof on the debt before it's willing to believe it.
That's all the time we have for this deep dive. Thank you for joining us.
Thank you. And remember, as always, this is analysis, not investment advice. Happy trading.